Hey guys, welcome back. Reversal trading can be one of the most profitable trading strategies you can use. You can trade reversals in trending markets, ranging markets, and even against the trend. We have discussed the concept regarding reversals in the 6th episode of this price action course. Do check out that video to know the basic stuff regarding how reversals work. In this video, however, we will talk about the reversal trading strategies with respect to price action. Reversals refers to large price changes where the trend changes its direction altogether. But the thing is that when it starts to occur, a reversal isn't distinguishable from a pullback. And the main difference between them is that a reversal keeps going and form a new trend while the pullback ends and then the price starts moving back in the trending direction, or simply the price will continue with its previous trend. Reversals often occur in intraday trading and happen rather quickly, but they also occur over days, weeks and years. Therefore, reversals occur on different time frames which are relevant to different traders. So, an intraday reversal on a 5-minute chart doesn't matter much to a long-term investor who's watching for a reversal on the daily or weekly chart. Yet, the 5-minute reversal is very important for an intraday trader. So, as a reversal trader, you are in essence a counter trend trader who is trading against the trend or the current market momentum. For example, let's say the market is in an uptrend, making a series of higher highs and higher lows. As a reversal trader, you will look to sell in that uptrend. Or for example, if the market is in a downtrend, then as a reversal trader, you are looking to trade against the trend and the momentum. Reversal trading, especially the trend reversal trading, can be a profitable way to trade the markets. However, like any other trading strategy, there is a correct way and a wrong way to trade reversals. Before we talk about the correct way to do reversal trading, let me first explain how you should not trade the market reversals, or simply I'll talk about the mistakes that most traders make while trading reversals. The first and the most important point to consider is to not catch a falling knife. For those of you who do not know what is catching a falling knife, it means trying to enter a long position in a market that is crashing down. So let's say the market is dropping every day. You don't want to blindly enter a trade because you are a reversal trader looking to buy low and sell high. There is absolutely no sense in trying to catch a crashing market similar to a falling knife. And why is it so? Because if you are buying into the lows of the market, there is no logical place for you to set your stop loss. There is no support or market structure you can refer to, and there are no signs that the downtrend could be ending anytime soon. And most importantly, trends need time to reverse their direction, as we have discussed in the market trends as well as market structure videos. So avoid catching a falling knife. The second mistake that traders make is entering the first pullback, anticipating that it will be a reversal. Now, this is a common mistake that traders make, that is attempting to trade the first pullback itself. This means that you go long when you see the market rallies after a huge decline. But often this type of a rally is only a retracement of the existing trend. And why do some traders always do this? And this is simply because of the fear of missing out, or FOMO. And you don't want to miss out on the next move. Thus, you enter a trade as soon as the market shows any sign of reversal. Unknowingly, this sign is usually a retracement or a pullback of the existing trend, and the market will continue the trend, causing you to lose your money. Now that we have understood about what not to do during a reversal trade, let us look at how to approach reversal trades in the market. The first and foremost point is to have a reference point on your chart. Now, what exactly is a reference point? A reference point can be a trend, a consolidation, or an area of value like a support resistance, a trend line, a moving average, etc., where there is a chance for some sort of a price action. Now, after you have figured out a reference point, the second point is to wait for the market to reach that particular reference point. Now, no matter where the price is trading right now, for a price action trader to make any sort of conclusion with the prices, it has to be in an area where there is a potential interest from the side of the market participants. or simply the price should be at an area of value. Now the third point to consider is regarding the trade entry. Now that the price has reached an area of value, you have to look for reversal candlestick patterns. You can use reversal candlestick patterns like engulfing candles or pin bars to time your trade entry. So you will enter a trade only after the market shows signs of reversal. However, you risk entering at a much higher price, which may lower your risk to reward ratio, but it gives you a higher win rate. Now the fourth point is setting up a proper stop loss. When it comes to stop loss, you want to place it at a level that invalidates your trading setup. This means if your stop loss is hit, then the pattern is broken and there is no reason to stay in the trade any longer. So it is generally a good idea to keep the stop loss with reference to the area of value and the highs or lows of the reversal candlesticks by giving the ample buffer space to save yourself from pullbacks. The buffer space can be decided using the ATR indicator or with respect to your risk appetite. And the final point to consider is to set a conservative profit target. Now your exits depend on your goals. So what do you want to accomplish? Either you can capture a swing or ride a trend. So if you want to capture a swing, then you can exit the trades before the opposing pressure comes in. For example, if you are long in the market, then you want to exit your trade before the next resistance level or the swing high where the sellers can come in. And on the other hand, if you want to ride a trend, then you can trail your stop loss as the market moves in your favor. For example, you can trail your stop loss using a 20 moving average. Now that we have understood how to approach a reversal trade, I am going to share with you 3 techniques which can help you identify reversal trades in the market. And as a reversal trader, you want to be smart about when you want to enter your trades. So here we go. The first strategy is the break of the market structure. We have talked about the different stages of market in the market structure video, and we also know how to identify a particular trend type from the market trends video. Now think about this. In a trending market, let's say an uptrend, the price makes a higher high and higher lows. And what do I mean by a break of the market structure? The break of market structure is the clue that the market is telling you that it is about to get weaker or simply it is about to reverse its direction. So in case of an uptrend, you have a break of structure when the price fails to make a new higher low or a higher high. So this is the first clue or the first evidence that the market is about to reverse lower. But there is no 100% guarantee that the reversal will happen. But it's an evidence given to you by the market that there is a break of structure and there is a good chance that the price could potentially reverse lower. Again, looking at the concept that I just shared with you, for an uptrend to reverse, we are looking for a break of the trend market structure. That is, what we are looking for is a lower high or a lower low which invalidates the uptrend setup. At this point, you have actually got a lower high, and when the price breaks below the area of support formed by the previous higher low, you will have a lower low. This tells you that this trend could be weakening and the trend could eventually reverse. Now the trend will not reverse all of a sudden because markets need enough sellers to bring the prices down, and so most often the market go into a phase of consolidation where the price will stay inside a range for some time and then it will show a trend reversal when there is an ample selling pressure available. This time when the price breaks out of the consolidation or the distribution stage and move lower is actually the best short trade entry for a reversal. In case of a tighter stop loss, you can keep the stop loss above the breakout candle high, and to be much safer and to avoid deep pullbacks, you can even place the stop loss above the consolidation range. The target in this case will be the nearest support level. Now let us consider this in case of a downtrending market. Again, we will apply the break of market structure concept. We can see that during a downtrend, there is a series of lower highs and lower lows. The break of downtrend structure comes when the price stops forming the lower highs and lower lows, or simply when you have a higher high because the price broke the prior resistance formed by a lower high, or if it formed a higher low. This again should give you a strong clue that this downtrend could possibly come to an end and the market could potentially reverse its direction. In this case also, the reversal may not come quickly. Instead, there can be a consolidation or an accumulation stage where the buyers can come in ample quantities so as to take the market higher. Here also, the trade entry would be when the price breaks above the accumulation stage and moves higher. You can keep a safer stop loss below the consolidation range, and the target can be set as the next nearest resistance level, or simply you can ride the trend until there is again a break in structure. Now, there is no such thing as guarantee in trading or in price action or in whatsoever. So if anyone promises you guarantees, then it's better to stay far away from them. This is why I like to use words like probably, likely, possibly. So keep that in mind. There is no guarantee for anything, and especially when it comes to trading. Now, the second strategy is the higher time frame reversal structure. So in a market, it's very important to pay attention to where you are in terms of the big picture, or simply you should stay attention to what the higher time frame is doing. This is where the higher time frame reversal structure comes in handy. In this example, the price apparently breaks above the swing high and then it collapses lower below the support level. At this point, a lot of unaware traders would have bought the breakout on the upside only to get caught on the wrong side. And why is that? This is a chart in the 4-hour time frame. Now let's see the same chart on a higher time frame, for example a 1-day period. On the higher time frame chart, it is evident that most of the traders are buying the breakout into a previous support level as shown that could eventually act as a resistance, and thus it makes a very low probability breakout trade. This means that the traders are buying into a huge selling pressure. And what do you think will eventually happen? It's pretty much no wonder why the market reversed from the resistance level. This is what I mean by a higher time frame reversal structure. So what exactly are we looking at? In case of this strategy, you have to look for a higher time frame area of value like a support or a resistance where the prices can eventually reverse, and you can then take a trade entry on a lower time frame with the help of a reversal candlestick for confirmation. In this case, there was a false breakout and you can leverage the highs of this false breakout to place your stop loss. Now the third strategy we will be discussing is using moving averages. You can make use of moving averages for reversal trading. In this particular technique, we will use the longer term moving averages like the 100 moving average or 200 moving average with a positional trading perspective. We know from the basics that if the price is above the 200 moving average, for example, we should try to stay long, and if the price is below the 200 moving average, try to stay short on the market. Now the reason for this is quite simple. If you think about this, the 200 period moving average summarizes the price of the last 200 candles based on your time frame. So if the price is right now above the 200 moving average, it is telling you that the price has been trending higher. And similarly, if the price is below the 200 moving average, it is telling you that the price has been trending lower. This is a simple way to tell you what's the long-term trend on the particular chart that you're trading. Why is it a long-term trend on the particular chart of your trading? It is because you could be using a 200 moving average on a 5-minute time frame. That is not really a long-term trend because it's a 5-minute time frame, right? Likewise, it can be a 200 moving average on a daily time frame. Then that's a pretty long time frame. So it is actually the long-term trend of the chart that you are trading, and depending on what time frame you are looking at. So let's use 200 moving average and 1 day time frame for this particular example. Over here, the price is above the 200 moving average. So from the basic rule, you want to look for long opportunities in this market. We can plot an area of support, and every time the price comes into the area of support, it forms a price rejection that is validating your trading setup. But the key point to note here is that the price is actually forming a consolidation and it has tested the support level multiple times. And you know what that means from the simple concept that we have discussed about supports and resistances in episode 6. And it is exactly what happened. The price broke down the support level and and even moved below the 200 moving average with great momentum. There wasn't any price rejection of any sort from both these areas of values. Now you can have a short bias since the price is trading below the 200 moving average, and now you can look for opportunities to go short on the market. Now this is how you can actually use the 200 moving average to give you a bias to know whether you should go long or stay short. And after you have identified your bias, then just reference to a market structure like a support or a resistance or even the moving average itself to kind of identify the area of value that you want to trade from. And sometimes the price will test the 200 moving average, which is actually an area of resistance, and if it turns out to be a false breakout of the highs, you can use the help of reversal candlestick patterns to take a reversal trade lower. Anyway, the 200 moving average is useful to help you find out the trend reversals and to identify the trade on the right side of the trend. Now these are some of the techniques which you can adopt and backtest in the market conditions to check if they work for you, and if it does, the entry and exits can be decided based on your risk appetite and patience. Now that is it for this video guys, and if you have learned something new today, please do like the video and subscribe the channel for more upcoming video courses. I will see you guys in the next episode. Till then, see you.